Welcome to Market Catalyst. I'm Ali Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Nvidia's red-hot growth slows. Full coverage ahead. Plus, Dollar General lifts its outlook as shoppers seek bargains. We'll bring you the details. And Nutanix slumps as its outlook disappoints. We sit down with the CEO later in the hour. But let's first get a check of the markets. Taking a look at the major averages, you're seeing some of the gains that we saw earlier today reverse. You're seeing losses being led by the tech-heavy Nasdaq Composite, down about 0.2%. Dow was off roughly 60 points. S&P off around 0.1%. So fairly flat here shortly after the opening bell. Of course, markets continue to monitor what we heard from Nvidia, and they did provide pretty solid results on both the top and bottom lines, although that data center revenue did miss expectations. So that could be what's leading to some of the pressure here for the index. I also want to take a look at the Treasury market. What's happening with bonds after Lisa Cook did file that lawsuit against President Trump going against the firing. You're seeing that we have the 10-year yield firmly below 4.3%, just trading at around 4.2%, relatively flat, all things considered. The 30-year yield, some buying there in the bond market that is bringing yields just a smidge lower, but again, fairly flat, not much action in treasuries. And overall, when we take a look at the bond market over the past month or so, we've been pretty chill. Of course, that could change as we near closer and closer to the Fed September rate decision. But turning to Nvidia CEO Jensen Huang saying that there's a real possibility the company brings its Blackwell AI chip to China, as he calls the China AI market a $50 billion opportunity. This comes after the company left China sales out of its guidance for the current quarter. Here's what Huang told Yahoo Finance about the importance of doing business in China.
Every American technology company, China is important to have. It's an important market. It's dynamic. The companies there are vibrant, innovative, fast-moving. I'm just delighted that President Trump sees the wisdom of American leadership, and particularly at this time where AI is taking off. It's vital that America wins the AI race.
Joining me now is John Vinh, KeyBanc Capital Markets Equity Research Analyst. And John, you just heard Jensen Huang's comments there on China. Do you agree with what he said? Does Nvidia truly need China in order to sustain this growth story?
I think China is an important part of every major tech company's future, right? They account for roughly 20 to 30% of end consumption more broadly. And within tech, they are always on the leading edge in terms of adoption of the latest technologies that we've seen with their EV cars, as we've seen with AI. So they are an important piece of the pot. I think Nvidia can sustain outsized growth without China, but certainly, China is going to be a very key driver of generative AI growth going forward.
And to that point, John, Nvidia's guidance was solid even without China, but the company did say that its forecast would have been $2 to $5 billion higher if those sales were included. So as an analyst, how do you model that kind of uncertainty? Because China, it's still unresolved. That 15% revenue share agreement in Washington has not yet been codified. So where are you looking at?
Yeah, I think their guidance, which excludes China, is probably the most prudent path forward. I think even if they were to include China, I think in the back of investors' minds, I think everyone would also want to understand what the China contribution is, right? Like the challenge with China is if it's, we're going to allow shipments back, but is the administration going to flip-flop back and forth as they've done in the past, right? So I think the best path forward, as we've seen, and the most prudent approach is for Nvidia to guide without China. We know obviously it's a source of upside, given that they've announced that some of those licenses have been approved. But I think going forward, I think we've excluded China from our numbers.
And you did raise your price target to $230 a share. That's up from the prior $215. Part of that reason is a $60 billion buyback authorization. What other catalysts are you seeing here when you look at the upside ahead?
Yeah, we're looking at a couple things right here. One is the ramp of their next generation Blackwell Ultra. It's going to carry higher ASPs into the back half of the year. They've already talked about shipping tens of billions of dollars in the second quarter. That's only going to be a bigger driver in the second half. The second thing is the improving rack shipments of their GB racks, right? This has been an area where they've been supply constrained, heavily supply constrained in the first half. We believe that they've been making significant improvements in terms of manufacturing yields. They talked about being able to ship about 1,000 racks per week right now. And as that flywheel starts to improve here in the second half, that also is going to be a significant upside driver. Those racks sell for anywhere from $3.5 to $4 million per rack. So you're going to see a nice ASP uplift from that going forward.
And we are seeing shares down about 2% this morning. That data center miss is still the core of Nvidia's story, and that seems to be what investors are focused on right now. How did you interpret that number, and what does that signal about the sustainability of demand, especially as Blackwell continues to ramp up?
That number was certainly disappointing, no question about it, right? There was also $650 million of sales of H20 China GPUs to a non-China customer. They said it was a one-time deal, but if you excluded that sale, numbers would have probably been in line or potentially a slight miss. But I think going forward, I think the most important thing that most investors looked is the guide. In terms of the near term, I don't think that this represents a deceleration in demand. I think this is more of a supply issue, as we talked about with the GB racks.
All right, John, thank you so much. Appreciate your time.
Great, thank you.
Well, continuing the Nvidia conversation, the chip maker has been at the heart of the AI boom, but is the trade sustainable? Nvidia shares have doubled since April, even as that data center miss lingers in the back of investors' minds this morning, with shares down about 2%. Joining me now is Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research. So Dan, you've called Jensen Huang the godfather of AI. You say he delivered once again, but we were just hearing from John Vin about that data center miss being disappointing. We've seen signs of slowing margins. You remain bullish, but are we flirting with bubble territory here, at the very least, seeing some more risks and cracks below the surface?
Yeah, I don't see any cracks. I mean, I think to some extent, when you factor the China numbers in, it's actually even more bullish than expectations. And I think if you start to go through everything and you're clearly going to nitpick, and was data center, obviously a little slightly disappointing. Yeah, but the reality is you're looking at probably the street underestimating growth by 25, 30%. That's why I think this is going to 5 trillion by early 26.
Can you factor the China numbers in though, Dan, considering all the unknowns that are out there? We just don't know if we're going to get that approval.
Yeah, the problem is that, look, and there's going to be skepticism on US-China, but the reality is that the biggest poker chip at the table is Nvidia. I believe they're going to sell into China. That's what ultimately could be 50 billion, 50% type growth. And again, there's one chip in the world fueling the AI revolution, and that's led by the godfather of AI, Jensen Nvidia. And I think that's how this is all going to play out. There would clearly be ups and downs, but I think when you read through it, that this is I believe just the start of a transformation that's happening in tech.
So then what keeps this rally sustainable and chugging along here? Is it still that data center build out, or do we need to see new AI use cases emerge in order to justify these valuations and for Nvidia to keep performing and outperforming like investors expect?
Look, I think it's about spreading, right? I mean, today it's only big tech, but now sovereigns are going to play. Think about Middle East. Think about everyone. So as this all starts to play out, you're now going to start to see globally Nvidia fueling it. We're talking about trillions of growth, and that's why I think when you look at AI, in my opinion, this tech bull market has 2 to 3 years at least ahead of itself, because we're just starting to play out. We continue to believe it's only 10 p.m., was 9 p.m. a year ago, but it's only 10 p.m. in the AI party. That goes to 4 a.m.
4 a.m. to the party. Now, we were just talking about China. Jensen Huang really stressed the importance of that market in his conversation with Yahoo Finance. And he also pointed to the Trump administration and how grateful he's been for their support. Take a listen to what he told us.
President Trump really understands and really wants, and it's his policy, to have America win the AI race. And that's really foundational. recognizing that that's important for national security, it's important for our economic security, it's important for American leadership around the world. And he understands that the American tech stack should be the world standard, just as the American dollar is the world standard that economies are built on. I've always enjoyed the conversation with the administration. They're very constructive. They're trying to help. They have a great sense of urgency, which I love.
So Dan, your reaction to Jensen's comments, do you see this as diplomatic posturing in any way to the administration, or is this a signal that policy really is central to NVIDIA's future?
Don't let the black leather jacket fool you. That's 10% politician in Jensen, 90% CEO. Look, right now, I mean, he knows he has the golden touch. And he continues to have that front row seat and really be a strategic advisor for Trump. But the reality is that if Nvidia can't sell into China, guess who gets strengthened? Huawei. So when you talk about the U.S.-China arms race, Nvidia plays a huge role. And that's why I think eventually, I mean, the coast will be clear, the green light's there, it's a pay-for-play model. China will be open.
And how much of NVIDIA's success and really the AI trade broadly tied to what we see in Washington? This feels like a story beyond just NVIDIA, especially as a lot of those big tech CEOs have been cozying up to the president and the administration.
It's new rules of the game, right? And I think, you know, from Cook to Jensen to everyone else, I think everyone's understanding how to play it. And, you know, when you think about everything that's happened in the Beltway, it is going to play an important role. Because right now, it's this arms race playing out between U.S. and China, tariffs clearly play in, and you got to see how the restrictions ultimately play out. But the reality is, for the first time in 30 years, U.S. is ahead of China when it comes to tech because of the AI revolution. And because there's only one chip fueling the AI revolution, it's godfather of AI, Jensen, NVIDIA.
Mm-hmm. Now, speaking of big tech, navigating Washington, navigating policy, Apple has been at the center of that conversation. We have the upcoming iPhone event. They just announced that date early September. Do you see that event as a catalyst for the stock, especially considering Apple shares have underperformed?
Look, it's a catalyst. I believe it's going to be a big upgrade cycle, and we've talked about it. But the reality is, Apple, they're playing baseball without a shortstop and a catcher. They're missing AI. And there's only one way they're going to do it. It's not from innovation within Cupertino. They're going to have to do an acquisition, whether it's Perplexity as well as doubling down the Gemini partnership. I think that combined with iPhone 17 are the keys to what I view as, you know, a stock going much higher, but they cannot miss this AI boat.
But Apple hasn't really been the buyer of assets, right? So I guess what do you think it would take, or what company would it take for them to really change that mindset?
We think it's Perplexity. I mean, it's clear as day that innovation's not going to be coming out of Apple when it comes to AI. And that's why I think they're going to have to do an acquisition. I think the writing's on the wall, and this is the time.
And another debate that was popping up a lot online, it was even a top Google trend, is Nvidia versus Microsoft. Obviously, two very different businesses here, but if you could only pick one that you would want to have in your portfolio over the next 12 months, which company do you think is best positioned?
That's like picking which of your kids you love
I know,
the best.
it's hard.
I mean, come on. But look, I think those two, they'll both, you know, I think they're both going to be in the $5 trillion market cap club. And I think when you think about who's fueling it, it's Nvidia and Microsoft. And those continue to be our two top picks, along with Palantir.
Mm-hmm. And it's because of AI. They're just utilizing those AI use cases the best out of the rest of the Mag 7.
They're playing a different game. They're like Scottie Scheffler playing golf.
All right. You heard it here. Scottie Scheffler playing golf. Dan Ives, thank you. Appreciate your insights as always. Some breaking news crossing the wire. Federal Reserve Governor Lisa Cook filed a lawsuit challenging President Donald Trump's attempt to fire her over claims she lied on mortgage applications. Cook filed the suit Thursday in federal court in Washington, kicking off a historic fight over independence of the U.S. central bank. Joining us now is our Federal Reserve correspondent, Jennifer Schomburger. So, Jen, this was expected. What do we know so far?
That's right, Allie. Good morning to you. Fed Governor Lisa Cook has officially filed a counter lawsuit in D.C. federal court this morning contesting President Donald J. Trump's firing of her, touching off a battle between the president and a Federal Reserve Board governor for the first time in history. Cook's lawyers are asking the district court for her to continue serving as a Federal Reserve governor while they contest the legality of the allegations. Cook bringing this lawsuit in her own capacity. She is not being backed by the Federal Reserve Board. The key question facing the court is the for cause that the president has alleged mortgage fraud seen in the eyes of the court as neglect of duty or malfeasance? In the lawsuit, Cook has claimed that the suit is, quote, an unsubstantiated allegation about private mortgage applications submitted prior to her Senate confirmation process and does not satisfy that, quote unquote, for cause requirement for termination as it stands at the Federal Reserve. She says President Trump did not purport to remove Governor Cook for inefficiency, neglect of duty, or malfeasance in office. All of this coming as, again, she is asked to continue serving as a Fed governor, just as NEC Director Kevin Hassett yesterday suggested to reporters that she should go on leave until these fraud allegations are resolved. The Federal Reserve sort of reserving status here on her status, I should say, deferring that until we see the legal proceedings resolved through the court system. It'll be interesting to see whether things are resolved in D.C. federal court or whether we see this kicked all the way up to the Supreme Court and whether a new precedent is set. Allie?
And Jen, we are seeing that the Trump administration wants to fast track Stephen Miron's Federal Reserve confirmation before that September Fed meeting. How likely is it that we'll see that? And what does that mean against the backdrop of this Lisa Cook lawsuit?
Yeah, it really all just depends on the Senate Banking Committee and whether they are going to be able to schedule a nomination hearing in time. I would expect that he would be confirmed by that committee. From there, however, he would also have to be confirmed by the full Senate on the full Senate floor. So that would be up to Leader Thune. The Senate comes back Tuesday after Labor Day. The FOMC meeting not till September 16th and 17th. A little bit of time there, but it would be a very tight table historically, given what we've seen for the Senate to move in that time frame. Of course, nothing's impossible, right? We saw that big, beautiful tax bill moved by July 4th. So if there's enough pressure from the White House, perhaps we could see this move forward. But that would be another dovish vote on the Federal Reserve for the president. And if the Fed does not vote to cut rates, even though Fed Chair Jay Powell has opened the door to do just that, then perhaps we could see a third dissent in September.
DC, keeping you very busy these days. Jennifer Schomburger, thank you so much. Coming up, a deep dive on Dollar General earnings and how the low-income consumer is holding up. That's next. Dollar General beat the street's expectations for the latest quarter. In addition to higher than expected sales and earnings in the second quarter, the low-cost retailer raised its guidance for the full year. Shares of Dollar General are already up over 46% year to date. For a closer read on these earnings, I want to bring in Anthony Chikumba, Loop Capital Markets Managing Director and Consumer Sector Head. So Anthony, really solid results here. Your reaction to what we saw, especially when it comes to how strong that lower income consumer has been.
These were very, very strong results. And the low-income consumer, I think that they're a lot more resilient than investors give them credit for. Generally, if that low-income consumer is working, if they're making more money, they're going to spend it, particularly at a place like Dollar General that really does mainly sell consumable items, right? They don't really sell a lot of discretionary items. These are must-haves, not necessarily want-to-haves. The other thing is they are seeing some trade down from higher income consumers who are looking for value in this uncertain macroeconomic environment.
Yeah, how big of a trend is that in these results when it comes to these higher income consumers trading down?
So they don't necessarily break it out, but it certainly is a tailwind. There's no question about that. And so this is the best of both worlds for Dollar General in that, like I said, that low consumer, their core customer is hanging in there, and then you are having this trade down. But they don't give a lot of specifics in terms of how much of a benefit they're getting from the trade down.
But what does that say for the retail space more broadly, especially as we consistently talk about this bifurcation of the U.S. consumer, how the higher income is spending, the lower income consumer is struggling? What can you glean from the fact that we are seeing higher income consumers going to these discount retailers?
I think what this means is that or retailers that cater to the middle, they're kind of screwed, right? In other words, if you cater to a high income consumer, you're going to be fine, right? And we saw strong numbers yesterday from Williams-Sonoma. We saw them earlier from our house. Those are definitely retailers that cater to low income consumers or high income consumers. If you cater to low income consumers, they're hanging in there, and you are seeing the trade down, right? And we saw that in Dollar General's results. We also saw that in Ollie's results. If you are, really going after that kind of mid-income consumer, that consumer base is shrinking seemingly by the day.
And when it comes to the tariff impact, what has Dollar General said about how they're trying to mitigate some of that risk, especially when it comes to their supply chain and their sourcing from China?
Well, you have to remember with Dollar General at this point, 75–80% of what they sell is consumable. So think food, think household cleaning items. That stuff's really not being imported. So tariffs just are not nearly an issue for Dollar General like they are for a lot of other retailers. Now, what they did say is that they are going to selectively take price. And by the way, that's what we're hearing from all retailers. So this sort of notion that China is going to pay for the tariffs, or suppliers are going to pay for the tariffs, or the retailers themselves are going to pay for the tariffs, not happening. I mean, they're passing along to consumers as much as they can. But like I said, for Dollar General, it's not nearly as much of a factor as it is for a lot of other retailers because they just don't sell that much imported merchandise.
And how sustainable do you think the momentum will be for some of these retailers that have benefited from that, considering the consumer, if they are going to be squeezed in other areas when it comes to tariffs? We've only heard it's going to get worse. How will that translate into what they're spending at these stores?
Yeah, so look, I mean, the second quarter earnings season is almost over for my companies. And what we have seen almost across the board is beats on revenues, beats on earnings. And in terms of updates to guidance, a lot of them have raised guidance, just like we saw Dollar General do. And so at this point, these broader macroeconomic concerns, elevated inflation, what's going on with the tariffs, it just hasn't necessarily translated. I mean, and I think a big part of that is that employment is still very, very strong right now. I mean, the unemployment rate is still down around 4%. We're still seeing pretty decent wage growth. And so, at least for the time being, retailers don't seem to be really being impacted by these broader macroeconomic headwinds.
Now, Dollar General shares are up nearly 50% this year. Do you still see upside from here? And if so, what's the biggest risk?
Yeah, so we have a hold rating on the stock, and a lot of it is the fact that, yes, we have seen this turnaround in their performance, but we think it is fully reflected in the stock price. And by the way, I mean, in terms of the turnaround initiatives, they basically said themselves that they're in the late innings. So you're not going to continue to see the benefit like we've seen over the last few quarters from the positive impact of these turnaround initiatives.
All right, Anthony, appreciate that. Thanks so much.
Thanks for having me.
All of your market action ahead. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We're watching CrowdStrike, Dick's Sporting Goods, and Walgreens. First up, CrowdStrike. The cybersecurity company narrowly missing sales estimates for the current quarter. The results suggest the company could still be in recovery mode after triggering a global computer outage last year. The report was CrowdStrike's fifth quarterly report since the July 2024 update crashed Windows operating systems around the world, leading to widespread disruptions across virtually every industry. Next, Dick's Sporting Goods. The company raised its full-year outlook, a welcome sign of strong consumer demand, as the retailer prepares to acquire sneaker chain Foot Locker. The CEO has been investing in Dick's stores networks, adding more experiential shops while improving e-commerce functions. The latest results show that these efforts are paying off with shoppers. Finally, Walgreens, the retail pharmacy chain, has officially gone private and will be replaced by Interactive Brokers on the S&P 500. The company was acquired by private equity firm Sycamore Partners. It also announced it's replaced its CEO with the former chief executive of Staples US. Walgreens reached a $10 billion deal with Sycamore in March to take the company private. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Mexico is set to raise tariffs on China amid a push by the U.S. Bloomberg News reporting the Mexican government plans to increase tariffs on China as part of its 2026 budget proposal next month. Yahoo Finance Washington correspondent Ben Worshgold is here with the details. So, Ben, does this have to do with pressure from President Trump at all? What do we know?
Absolutely. Yeah, this is a top priority of President Trump for weeks. The overall idea here being from the White House's perspective that it needs Mexico to help the U.S. squeeze China out of supply chains kind of in the Western Hemisphere more broadly. So this, if Mexico does indeed follow through with this, would be a major concession. Another important fact of this report is that these duties could include other Asian countries as well. So this could be broader than just China, but could be sort of a pivot for Mexico, at least away from Asia more broadly. That's all said, we don't have fine details of what this budget proposal is set to say yet, whether it's specific goods or more broadly, but it would indeed be a major concession. I think one other point to make stepping back, putting this headline this week alongside the India headline this week is kind of a diverging paths we're seeing in Trump's trade war in kind of heightened evidence this week. Trump is also making a key demand on India, which is to stop purchases of Russian oil. And the response from India has been to do the exact opposite. And they are rapidly increasing ties with China and Russia. The Prime Minister, Narendra Modi, is scheduled to go to Beijing for the first time in 7 years, starting in a trip that starts this weekend. So what we're seeing here is that the Trump administration is kind of essentially forcing countries to make a choice. It's either kind of us or them. And what we're seeing is two kind of key examples of countries making the opposite side. As Capital Economics noted about Mexico this morning, Mexico was very susceptible to U.S. pressure, and that appears to be following through. India is clearly in a different boat.
Yeah, that escalation with India surprised some of the experts that we've been talking with. But what does that mean, really, and this deal mean for other types of trade talks? We know that U.S.-China still ongoing. We just heard that Japan's best tariff negotiator scratched a visit to the U.S. Put that into context for us.
Yeah, I think the Japan example is a telling one as kind of countries that are in the middle at the moment of this divide. Sort of the question being how far of a decision they have, how far they're going to have to go to choose a side. As you mentioned with Japan, Japan's top trade negotiator was scheduled to make a visit to the U.S. this week. Japan is trying to kind of improve the conditions of its deal. A last-minute cancellation there. He told reporters in a press conference that they needed to kind of talk more amongst themselves before this visit. So they're clearly having a lot of trouble, even with the deal, going through the implementation process. Two other nations I'd put in the similar bucket is South Korea. South Korea was here this week trying to improve their deal with the U.S. and kind of came away empty-handed, according to Trump. Trump said, they came here trying to get something. They left with exactly the same trade deal, at least, that they had before. The EU is in a similar boat. They're working to implement it, but there's a lot of details still being worked out. So we kind of have these polls, and then we have a lot of countries kind of trying to decide whether they have to make a choice in the months ahead.
Well, we'll keep watching, and I know you will as well. Ben, thank you so much.
Mm-hmm.
All your markets action ahead. Stay tuned. You're watching Market Catalysts.
A recent report from Citi highlights sectors outside of the AI trade where investors can look for opportunity, including fintech and wearable technology. We're navigating how to play outside of the AI sector with the Yahoo Finance playbook. Joining me now is Drew Pettit, U.S. equity strategist at Citi. Drew, it's good to see you. So when you were searching for these non-AI opportunities, Drew, what were you searching for? Can you walk me through your screen?
Yeah, so first and foremost, I was looking for something where investors can complete their portfolios. We get it. AI is and has been an amazing theme to be invested in. It's still one of our favorite themes. We don't think you can ignore it, but that's really just the growth side of your portfolio. You need some value exposure. You need some stuff to basically round out the portfolio. So first and foremost, I was looking for more value style stocks and themes that can complement AI and build out a well-rounded portfolio.
And so what came through that screen? It sounds like fintech and wearable tech, Drew?
Yeah, so these stuck out because, look, even if you are a value stock or a value theme, you're not cheap. And I always air quote cheap. But here you need good earnings follow through or an earnings growth inflection. You need solid quality metrics because, again, you're not cheap. So when fintech and wearable tech, so that's a lot of kind of healthcare devices, they stood out because they had really strong fundamentals and they weren't priced to perfection.
So if you're already overweight AI, how as an investor should you think about these kind of non-AI themes? How should they fit into your portfolio, Drew?
Yeah, it's funny. So thinking about the balance, I would say AI, even when you think about the S&P 500, it's probably about 50% of your portfolio, at least your US equity portfolio. So these other themes attach around the outside of it or adjacent to it. So you should be looking at a pretty heavy weight, let's call it maybe half your weight of your US equity exposure in AI. The other half can go into these themes. They can go into broader areas like financials, utilities as well. I think it's a really nice way to kind of complement and blend everything together.
We talked about the valuation for what came through the screen, Drew. How did earnings growth look?
Yeah, so it's funny. For value, let's just start high level. Value, you're starting to see earnings growth inflect. For the next year, you should see earnings growth of almost 10%, but we don't have a lot of confidence in that actually being true because we've seen a lot of earnings downgrades for value as a whole. For fintech and wearable tech, we expect these to grow between kind of high single digits in the low teens. But the difference here is the revisions have actually been really stable. You haven't seen a lot of cuts to 2026 numbers. So you should see premium growth to the other half or the value side of the index. But again, not fully priced in.
Any specific names you highlight for us, Drew?
Yeah, it's funny. On fintech, we go back to some old school names that are kind of market leaders in integrating. So Capital One Financial, who just bought Discover Cards and so on, BlackRock, Charles Schwab, and then even someone who's tied to the mortgage market, Equifax, for example. I think those are really interesting fintech names, maybe not as techy as interesting as people think, but offer really good value, and our analysts have pretty strong conviction. On the wearable tech side, Boston Scientific and Medtronic, two different stories. Medtronic, more of a turnaround. Boston Scientific, basically the best in the space, if you ask our analysts.
And I know this is a non-AI discussion, Drew, but in this report, did I see that, did you add Nvidia to your AI at a reasonable price basket?
It was in there before, and this is kind of the interesting story when you think about Nvidia tonight. It's not really about where the stock is priced or what's going on in the quarter. It's about the out years. And this is a stock, even though it keeps moving higher, the out year estimates for 2026, 2027 keep moving higher. So to us, we thought it was a really good time to add this to our portfolio because it hasn't been there this year.
Drew, finally, I was talking to a strategist on the show today, longtime market watcher like yourself, and I asked him, what is more important to the market now? I said, Drew, is it the Fed or is it the great AI trade and trend? He said the latter, but what do you think, Drew?
It's funny. If I had to pick between the two, I might agree and say the latter. But to us, it's the fundamentals in what AI and tech development and innovation means for company fundamentals. It's not just the tech companies that can benefit from this. We see AI permeating a lot of different industries, and it should show up in better margins, better productivity, better sales and earnings per employee. All of those enhancements really make the S&P 500 a structural winner. So yeah, between the two, I would pick AI and tech innovation as well.
Drew, always great to see and to have you on the show. Thank you.
Yeah, thanks for having me.
Shares of Nutanix are under pressure after the cloud computing company issued first quarter revenue guidance that underwhelmed investors, even as earnings and revenue last quarter topped expectations. Joining me now to discuss what this means in the ultra-competitive data storage sector is Rajiv Ramaswamy, Nutanix CEO. Rajiv, let's start there on the guidance. Why the outlook miss after such a strong fiscal 2025?
Actually, our guidance was actually above consensus for the year. We gave our full year fiscal guidance, and it's actually above consensus both on the top line and on the bottom line. So we are actually, again, quite happy with our initial guide for the year. And we're also happy with the year that just ended in terms of, again, we came in above our guidances on everything. We added 2,700 new customers, including some significant customer wins, such as Finance Informatik in Germany, the majority of the German population banks with them, and they're on a long-term partnership and journey with us, moving away from their legacy vendor. So we're actually quite happy about our results. We're actually quite happy about the fact that over the last several years we've delivered good, top line growth as well as increasing bottom line profitability, and we're continuing on that mission.
So we are seeing shares, though, down around 7%. What are investors then missing about the longer term story here for your company?
Yeah, I think it's, again, I can't speak for the investors per se, but what I would say is we have a number of growth drivers in front of us. And what we've said is these growth drivers will take time. It's a multi-year journey. So we have this massive data center opportunity in front of us to be able to go modernize the infrastructure, to be able to migrate customers from legacy infrastructure and legacy vendors to a modern cloud-like infrastructure, run cloud-native applications, run AI-native applications. The infrastructure business happens gradually. So we are adding customers at a solid clip, and we expect to continue doing that this year. So I don't know, this may be some near-term catalyst, near-term profit taking in the stock as well, because we've had a good run over the last several years. But I'm very confident about our long-term prospects here and the opportunity in front of us.
Yeah, and 2,700 new customers, so really strong there, the most in 4 years. Where is that demand coming from? How sustainable is that pace as we move into 2026 and beyond?
Oh, I think it's, first of all, very sustainable. The demand is coming from, first of all, organizations around the world. If you look at that mix of companies, that includes large companies at the very top of the pyramid. For example, out of the 2,700, there were about 50 global 2,000 customers. So these are the biggest of the biggest out there in the world that have also signed up with us. And if you look at the big picture, Nutanix today has about 29,000 customers. There's 200,000 potential customers out there for us, and the market opportunity is close to $100 billion. And so we have a long runway ahead of us to continue executing, to continue growing our share in this market.
And the industry is still processing that Broadcom VMware deal. You used to work at VMware. You served as COO. How has Broadcom's handling of that business impacted yours? Are you seeing a lot of migration?
Yeah, we look at this as a multi-year tailwind for us. Because again, what Broadcom has done in terms of raising prices and others, a lot of customers are migrating. A great example is this Finance Informatik. They service all the German savings banks, right? And like I said, big customer, they have a lot of legacy infrastructure, legacy vendor, and they decided, okay, they want to modernize. They also want to go with a vendor that they trust for the next 10 years that they can do business with. And that's the kind of partnership that we aim for, right? Very long-term partnerships with these customers.
Now, some of your customers are in China. You do have that China exposure. There's been a lot of back and forth on policy. We just heard from Nvidia. They're very much caught in the crosshairs there. How does the political uncertainty, does that have any impact on your business?
Actually, we don't do business directly in China. We stopped that about 4 or 5 years ago because from a software perspective, it wasn't easy. Software licensing is challenging to enforce in China. And so for the last many years, we have not really had a significant business in China. We've been focused on the rest of the world where there's still huge opportunity for us. So China hasn't really impacted us in any significant way.
And when it comes to the AI build out at large, how does Nutanix fit into this? We know that it's a multi-year story, that companies are aggressively spending on AI. So where's the long-term growth and how you fit into this larger narrative?
Yeah, we think it's a huge long-term opportunity for us. If you look at sort of the phases of AI development, a lot of the money is now being spent on building these massive compute farms for training, for developing these foundation models, for training these models on generic data. And that's the training part. Now, the next step really is in terms of companies and organizations using these models to build real life applications, so-called AI native applications. That's called inferencing. That's where we are exposed to. So we are squarely in the inferencing opportunity for us as companies actually start using these models, taking them and then use them for real life applications. Great examples of this. For example, we are working with a large federal agency as they look at money laundering patterns and using homegrown proprietary applications to detect transactions that may not be legit. That's one great example. We have companies like retailers using us in stores to be able to go do things like creating, again, fraud detection is one use case, but creating automatic checkout lanes, simple use cases like that are all there. A lot of document summarization, support use cases. In our case, for example, an internal use case for us is we were able to use our own platform and open source models to reduce our time to resolve customer issues and customer support by about 10%. And we think we can get a lot more of that. So that's the market that we are focused on, the inferencing market. I would say it's pretty early on because most companies at this point are just really starting their journey. But we think that's going to be a huge opportunity for the next many years.
Long-term growth there. Over the past year, Nutanix shares are up around 23%. Rajiv, thank you so much. Appreciate it.
Thank you for having us.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, we break down the impact tariffs are having on the retail sector. Plus, we'll hear from Nvidia CEO Jensen Huang on the company's latest results and what comes next for Cracker Barrel. We discuss with Bar Rescue's Jon Taffer. 90 minutes into the start of U.S. trading, I'm Ali Canal. Let's get you a check of the markets. You're taking a look at the major averages here. We're seeing a mixed picture. We have the Dow down around 0.2% or roughly 100 points. The S&P 500 is essentially flat, and the Nasdaq is up around 0.3 point. That is despite the fact that we had Nvidia earnings underwhelm investor expectations. I'm looking at Nvidia shares down just around 1%. Well, with retail earnings season beginning to wrap up, we want to take a closer look at some of the winners and losers in the space and some of the risks facing retailers that investors may not have considered. James Gellert, Rapid Ratings Executive Chair, joins me now. So, James, we are wrapping up earnings season. I'm curious which retailers have stuck out to you.
Well, Ali, I think we're in a place where we're seeing the larger companies with more staying power, bigger balance sheets, and larger footprints in a much better position than their smaller competitors. But this is definitely a time when I would say no one should rest on their laurels because we really haven't seen the full effect of tariffs coming through. A lot of the earnings that have come through so far in the last couple of weeks have been stronger than expected. Companies like Home Depot have done well. Kohl's did well yesterday, which was a surprise to, I think, many. Dollar General this morning did quite well. So I think we're beginning to see a period of time that we're going into where the larger companies are going to continue to do well for a while, but they're having to work extremely hard to do that. And by that end, what I mean is they're pulling out everything they can from their playbooks, particularly trying to work really closely with their suppliers and their supply chain and the providers of product that they're putting on shelves to get the best prices that they can, but to try to collaboratively work out how the costs from increased tariffs will be shared. It's not always being successful, and there's still a lot of pain to come, but we're going to hear a lot over the next couple of quarters more about that than we're hearing so far.
And you noted the success of some of those budget retailers like Dollar General, TJX. Your data shows that they remain in low-risk territory, but considering that tariff impact that you were just mentioning, how sustainable is that outperformance, and how are these companies protecting their supply chains?
Well, right now, the supply chains that are the companies that are doing the best with their supply chains are engaging with them, speaking with them the most closely, and trying to understand where those companies can share some of the cost increases. What we're seeing across industries, retail is just one of them, is this real schism between larger public companies and their smaller private company suppliers. And most Fortune 500 and Fortune 1000 companies, about 75% of their supply chains are made up of private companies. So as go private company health, goes ultimately their customers. And right now we've seen since the beginning of COVID to today, a real decrease in financial health and a lot of real top line sort of scary metrics. Operating profit down 20%, 22% for private companies and relatively flat for their public counterparts. Net profit down 220%, leverage up 120%, interest coverage down 63%. These are all really big warning signs. And the public market watchers are not necessarily getting to see that this is happening upstream among private company suppliers. So the retailers in particular that are doing a good job are working well with those suppliers and trying to figure out who can handle those cost increases, how they can be shared, how they can be passed through, to what degree. But somewhere in the elasticity of a supply chain from the end consumer all the way up to 3 or 4 levels in the supply chain, everyone's feeling some pain, and a lot more pain is going to come.
So considering those numbers you were just going through with those smaller private retailers, should we be bracing for more Chapter 11 bankruptcies?
We'll definitely see more bankruptcies. We already are seeing the most bankruptcies since 2010. We're seeing roughly a 10-to-1 clip, private bankruptcies to public, or private companies to public. And also concerningly, we're seeing a lot more restructurings than we would see in a normal year. So that really means that both creditors and borrowers are doing more to try to forestall a bankruptcy, get ahead of it, change cap structures, change the nature of the financial instruments that they have in place. And all of that is really with an anticipation that there will be a tougher credit environment going forward than there is today. Keep in mind that most private companies borrow from banks. They don't borrow from longer-term fixed income institutional investors. So as rates have stayed high for a longer period of time, those companies have had to absorb that cost of higher interest rates, which has gone to that net profit hit that I talked about before.
And what can we learn from some of these bankruptcies of the past? We were just showing a graphic of all the different companies that we've seen. What went wrong with those firms?
Well, look, from a financial health perspective, we usually can see the deterioration in these companies for certainly quarters, in many cases, years ahead of bankruptcy filings. Over the last 20 years, over 90% of companies that have failed, we've had rated at 40 and below. And if you look at some of the more notable bankruptcies, particularly in retail over the last, let's say, year, companies like Joann's, for instance, most of the companies have been rated 30 and below, and some of them as low as in the teens. And generally, what we're seeing there is companies that are taking some kind of a major top line hit because of changing consumer preferences, or they've gotten some strategy wrong. You're seeing higher costs of labor, higher costs of parts that or product that they're putting on their shelves, higher indirect costs because of perhaps not as careful management of their indirect suppliers. And then you're seeing, generally speaking, higher debt. And that debt cost has been a real killer for a lot of these companies. So the fuse lives that they've got in liquidity are being burned down at a faster pace than their operating profits can replace them.
Now, you point out that the bulk of retail suppliers are private companies. So if those companies start to raise prices or failing outright, what's that triple effect to those bigger giants like a Dollar General?
Well, it's really a question for them on whether they can absorb that cost themselves or pass it or some of it along. In the case of a Dollar General, interestingly, they don't have a lot of non-U.S. first-tier suppliers, so it's a relatively small single-digit number. So people would look at that and say, well, they're not that terribly exposed to tariff risk. The problem is many of those suppliers are exposed to tariff risk because they are buying from overseas. That would be Dollar General's tier 2 suppliers. And if a tier 2 supplier is raising prices because of tariffs, or they're in more financial duress because they're absorbing those costs, that will affect the Dollar General supplier. That will ultimately affect Dollar General and the consumer that's paying a price and expects to pay a price at that store.
All right, James, super interesting insights. Thank you for the time today.
Good to be with you.
All your market action ahead. Stay tuned. You're watching Market Catalysts. Big bank stocks have been on a tear over the past year and got fresh fuel after Fed Chair Jerome Powell opened the door to a September rate cut. But can it last? Joining me now is Chris Whalen, Whalen Global Advisors Chairman, along with Yahoo Finance banking reporter David Hollerith. So David, let's start big picture with you here. I'm seeing XLF up around 11% since the start of the year. What have been the catalyst here? Has it all been driven by those rate cut expectations?
Yeah, Ali, it definitely hasn't been. But, if we zoom out to exactly a year ago, so 12 months ago, that was the exact same topic the Fed was, investors were excited about the potential for the Fed to lower interest rates in the fall. So it's kind of been an interesting dynamic where while that did happen, the Fed stopped cutting this year given concerns around tariffs. And their impact on inflation. But we have seen investment banking and some sort of deregulation agenda from the Trump administration prove pretty favorable for the biggest banks. Now, what I've been paying attention to has been the KBW NASDAQ Bank Index, which tracks the 24 largest banks. And that has actually notched new highs Tuesday and yesterday, Wednesday. And that has really come around this most recent attention to potential cuts in the fall.
Yeah, and deregulation, that has been looked at as a tailwind for the banks moving forward. And Chris, to bring you in here, you just heard David laying out some of these catalysts. There's been parallels drawn to the mid-90s rally. So Chris, do you think that the leg up can last here?
The big catalyst, I think, for financials was back in April after the Trump tariff announcement. The whole sector sold off. I bought some American Express at the lows, which was, a 5 handle for book value multiple. And then I just kicked it out last week at a 27% gain. I think that rate cuts are certainly always a positive for banks. But what I would point out to you guys is that the market has rallied in the past 2 months. We have dropped loan yields down 0.5 point. Mortgage yields are down around 6.25 this morning versus 7% before July. So the market is rallying even while we all stand here talking about the Fed. I think financials have done very well. But, David, don't spend your time looking at the KBW. It's a dog. Half of them are great. Half of them are underperformers. You want to look at the top guys like Amex, JP Morgan, Axos, Synchrony. These names always lead the group significantly. And, I just kicked out some Schwab. There were a couple other names. Fannie Mae had been a really great performer. I picked up almost 30% on that stock. But now they're kind of, slowing down simply because we kind of sort of know what's going to happen with rate cuts. I'm still not sure they have a majority next month, Ali, for an actual. We may see the Republicans, Powell and the other 2 Republican governors vote for a rate cut and lose. What do you think the markets would do then?
Yeah, and that's a question I've been asking guests, is that it's not really a done deal at this point that we will be seeing that September rate cut, considering all the data that we have to see. But we have seen more broadly deal making just top $1 trillion, the strongest August since 2021. Yep. Now, you said a lot of these AI-related deals are heavy on hype, light on substance. So what are you seeing in this M&A cycle?
Well, AI is like an electronic parrot. And humans are comforted when they can talk to something and it responds with a human voice or something that sounds like a human voice. But when I follow the technical community and their commentary on AI, it's extremely cautious because what we're finding with these large language models is that they have really significant confirmation bias and other issues in terms of just rolling them out and using them for general applications. I love playing with it for search, for example, on Google. But I think a lot of these deals reflect the time, which is inflation, Ali. When you look at those numbers for M&A deals, what it's telling you is that everybody still wants to make their 20, and they're going to push stock prices up accordingly. There's a dearth of really interesting deals out there. And I think that's one of the reasons after yesterday's earnings for Nvidia, the stock didn't move very much. Everybody was predicting it was going to sell off significantly. I've had a stop loss under my Nvidia position for a month, and it hasn't gone down to, it's at $170, right? So, to me, the whole point of this market right now is inflation. You see this with banks. JP Morgan at 2.5 times book, and it may go higher. That's the funny part.
And David, I want to bring you in here. Do you agree with that? What are your sources telling you when it comes to inflation and really these underlying results that we've been seeing from the big banks?
Yeah, to reiterate, a lot of it has had to do with the Wall Street profits, which has been trading and investment banking. What I've heard from sources is that obviously, as Chris has been talking about, like the number one concern about this potential for interest rate cuts in September has been the impact of inflation and whether or not the full impact of tariffs will come to light sooner or by then, excuse me. But the real implication here, especially with the KBW index, is that lower interest rates perceivably would lead to more lending growth. And that has been what's been toughest for banks on their non-Wall Street profit side. So sort of the underperformers of this year would see more benefit. And that's kind of like the thinking of why there's been a rally in that specific index.
Got it. And we did see some results early this morning. TD Bank did report solid results, although we are seeing shares down around 4%. We saw profits beat expectations. A loan loss provision came in lower than feared. But the stock is up, even with these losses, almost 40% since the start of the year. So, Chris, how do you see TD positioned amid some of these other big bank competitors?
I think what's happened is that equity managers saw the sell-off in April. They have come back into financials with both feet. And even the underperformers are coming up. You see this in mortgages, for example. Stocks that were dead money 2-3 months ago are moving higher because people are increasing allocations. What I will say to you, Ali, is I'm putting out our quarterly for next week, and I am really concerned about the street's exposure to non-bank financial firms, not mortgage firms, but hedge funds and everything else. The rate of increase in those exposures is striking, and I think all we need is one surprise, and you're going to see financials sell off again, which to me will be a buying opportunity. I was happy to see TD with better results, but frankly, I am still in mourning. They should not have sold their stake in Charles Schwab. That was a terrible, terrible mistake on their part. I would have kept Schwab and sold the U.S. retail bank, which is frankly barely making money. Canadian firms are generous. They love coming down here to the States and investing in U.S. retail properties, and they've always done badly. I think, TD should stick to what they do well, which is asset management. They're a big player in Canada. And frankly, holding on to a 10% stake in Schwab would have been the best investment they could have made. So,
yeah, we'll see where TD trades in the future and if we do see that pullback in the financial stocks. Chris, David, thank you so much both for joining us. All your market action straight ahead. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We're watching Pure Storage, Hormel, and Victoria's Secret. First up, Pure Storage. Shares of the cloud storage provider surging. Second quarter fiscal results topped estimates, and the company raised its full year forecast. Second quarter revenue grew 13% from a year ago as the company saw broad-based strength across its entire portfolio. JP Morgan analysts noting that Pure Storage pleasantly surprised investors with significant revenue momentum in the quarter. Next, Hormel. The maker of deli meats posted third quarter profit that missed estimates and cut its full year guidance. The company's CEO said the steep rise in commodity input costs affected its industry and was the largest contributor to its profit shortfall. The company expects the near-term pressures to continue into next year. Finally, Victoria's Secret. The company is warning of a $20 million tariff hit in the third quarter and a $70 million impact in the fourth quarter. But despite that worse than expected headwind, the lingerie, clothing, and beauty retailer did raise its full-year sales outlook after second quarter strength was strong. It now expects growth sales between 6.3 and 6.4 billion, up from a prior range of 6.2 to 6.3 billion. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Nvidia CEO Jensen Huang joined Yahoo Finance last night, underscoring just how crucial the AI market is, and even pointing to the Trump administration, saying he's, quote, grateful for their support. Take a listen.
President Trump really understands and really wants, and it's his policy, to have America win the AI race. And that's really foundational. Recognizing that that's important for national security, it's important for our economic security, it's important for American leadership around the world. And he understands that the American tech stack should be the world standard. Just as the American dollar is the world standard that economies are built on, we want the American tech stack for the world's technology and industries to be built on. And that includes China. And so if you look at China, China has 50% of the AI researchers in the world. They have lots and lots of AI companies, and they have lots of AI chip companies. Without us there, they will obviously have their own alternatives, and they've been growing. And you've seen some of the AI chip companies have record years. Their stock prices are record high. You know, obviously, there's a lot of opportunities there. If we have an opportunity to go compete for that market, it would be great for America. It would be great for China. And we have an opportunity to go capture some of that $50 billion that is growing at about 50% every year. The second largest AI and computing market in the world. America should be part of that. It's great for exports. It's great for our treasury. It's great for American technology leadership. And it enables us to leverage that leadership all around the world. And so really important for it's just an incredible decision by President Trump. I'm very, very pleased with it, very grateful for his decision. And we're gonna do our best to go capture some of that market.
And talk to me about what it means for Nvidia specifically, Jensen, because, you know, even at full strength, China was about, call it 10 to 15% of the company's sales. And so I'm curious if you think of China as a nice to have or a need to have for Nvidia, and whether you need sales into China to keep up the pace of rapid growth that you've been experiencing.
Every American technology company, for every American technology company, China is important to have. It's an important market. It's dynamic. The companies there are vibrant, innovative, fast-moving. That's one of the fastest growing technology markets in the world. The technologies that are used there, the services that are created there, the open source models. China builds most of the world's open source models today. And DeepSeek, of course, we've spoken about before, really important model. Q1 from Alibaba, really excellent. Kimi is excellent. Moonshot's model is excellent. There's a whole bunch of really excellent models. Another one just came out, Seed from ByteDance, really excellent. And so the open source culture is really vibrant there. Those open source models has spread all over the world. They're used by startups all over the world, including here in the United States. It's used in enterprises all over the world. Open source models is making it possible for people to create market-specific, domain-specific, and company-specific models. Really important for American technology companies to be able to run those models really well. And so I think China is just an important market. It's also, as you know, it's just really large. It's the second largest computing market in the world. I'm just delighted that President Trump sees the wisdom of American leadership, and particularly at this time where AI is taking off. It's vital that America wins the AI race.
And so, Jensen, what now needs to happen, right, to get you there, to get not just you there, but other American companies there? How do you overcome that sort of political hurdle?
Well, for a while, these American AI technologies are stuck in limbo. And so now we're getting the engine fired back up again. And so I'm looking forward to, and I hope that the China market and the Chinese government will allow American technology companies to be able to sell to the Chinese customers. There's a lot of demand there, although there's a lot of alternatives there. The China AI technology companies are really good, as I mentioned. We can be very competitive. You know, you're talking about America's technology industry. It is our national treasure. It is incredibly competitive, and we have every opportunity to succeed in China market if they would allow for American technology companies to be able to play there. And so I'm hoping that things will get sorted out. I believe there's a lot of demand for H20. The CUDA ecosystem is really vibrant in China. We've been there for a very long time, and so we can add a lot of value if we can get back in. And so, anyways, we've now taken care of we've now been approved and licensed to be able to ship to China. Now we're looking for orders in China, and I'm hoping for it. If it doesn't happen, of course, we've already guided to another record quarter next quarter, and the China business would be a bonus on top of that. But hopefully we'll be able to address that 50 billion, growing very fast AI market long term. Really important for the United States.
It's good to have options, and that's what we're talking about on today's Stocks and Translations, as I'm joined by Sean McLaughlin, Chief Option Strategist at All Star Charts. Sean and I are going to break down an options trade in United Health in a minute and tell you how to potentially squeeze some profits out of this dog of the Dow, which has been cut in half this year. But first, let's break down some basics. We have two basic components in options. We got calls and puts, and we got a little grid here. And so you can do two things with either a call or put. You can go long and buy it, or you can go short and sell it. And this creates different rights and obligations here. Maybe you can break it down for us.
Sure. So if you buy a call, that's a bullish move. You are betting on the price of the stock going up. And if you are an owner of a long call, that gives you the right but not the obligation to take ownership of the stock at the price of the strike.
Right here.
Yes, and you pay a premium for that. The premium tends to be, a couple dollars depending on how far away the strike is. But the nice thing about buying a call, or in this case also buying a put, is your risk is defined to what you pay. You cannot risk or you cannot lose any more, which, hey, if you have a stock that has a severe gap against you overnight, maybe due to earnings, you like having that comfort of knowing that
you don't get surprised.
You're not going to be surprised. You can size your position in a way that you know the most you can lose. And that's a really good way to sleep at night.
Now, Sean, what if you don't want to sleep at night? What if you're a fan of unlimited risk? Let's talk about the short side here.
Well, if you like unlimited risk, then selling naked short calls would be the way to go. Selling a naked short call is attractive to certain traders because they like to collect the premium, and their bet is that the option is going to expire out of the money. So let's say...
So another trader is going to pay you for that money. That's called the premium, and then you get to keep that. And then, sorry to interrupt you there.
Yeah, so if the stock closes below the strike price of the option, let's say you sold a 100 strike call and the stock closes at $98 on expiration day, then that premium that you collected when you sold that call is yours to keep. You don't owe it to anybody, it's yours. And it's considered a high probability bet. So if you sell an out of the money call, you have a better than 50% chance of making money. However, the downside is
unlimited risk.
Unlimited risk. You could have a stock that could rip, 50% on you, and you are on the hook to buy that stock to cover your short position, and the risk is unlimited. The stock can go.
Yeah, and we're talking the minimum size for an options trade is 100 shares. So you could actually end up with a highly leveraged position going against you.
That's right.
We're going to talk about this United Healthcare trade, but first we got to break down what we're talking about. The covered call. This is where you sell a call option for 100 shares at a set price and an expiration date on a stock that you already own in an equivalent amount. So if I own 100 shares of United Health, I can match that with an option, and tell us how that covered call works.
So if I owned 100 shares of United Health or any stock, I could sell an out-of-the-money call against that position. That out-of-the-money call obligates me to sell 100 shares at the strike price. So with UNH trading around $300 last I looked, you could sell a 320 call, and if United Health doesn't get to 320 by expiration day, you keep that premium. And then you can do it again if you'd like. And this is a way that people who own stock like to enhance their yield or lower their cost basis in a long stock position.
And that works out really well if you happen to be down 40% in the stock, which is what it's lost this year. Now, here is a profit and loss chart of an options trade, the one we were just talking about, United Health. This has to do with the September 325 call. I know prices have changed over the morning, so maybe you like the 320 better, but this is the same basic principle here. And let me break this down, because I know a lot of people here are not used to looking at one of these charts, but on the horizontal axis, right down right here, what we call the x-axis, that is the United Health price at expiration. So right now it's at 300. If it got all the way up to 600, this is what we'd be looking up right here, and that's very unlikely, by the way. And then the vertical all the way down by Sean, this is how much you're gonna profit or lose in the trade. And so we've shaded in. The green is a potential, and you're gonna notice it's just a little amount. And then the red, you do have some downside there. That happens to be because you're owning the stock.
Right.
Just kind of fill in the gaps here with my very brief explanation.
Sure, so the downside you're seeing here, that's just, the risk of owning the stock. But when you sell a call against it, that lowers your cost basis. So it's not a perfect hedge against losses in a stock. Really what people are doing when they're selling calls or covered calls is they're trying to enhance their premium. They're making the bet that the stock is going to remain somewhat stable. It might rise a little bit, but they're really just trying to enhance their yield. And ideally, in a perfect world, you kind of get to do this every month. You sell the September calls, they expire worthless, then you do it again in October, then you do it again in November, on and on and on. And hey, UNH pays a dividend. So not only are you collecting
multiple income streams.
Yeah, you're getting the options income, but you're also getting the dividend income because you're holding the stock. So win-win.
Now, what if the stock goes up, though? You can see, like, we have all these prices up to $1,100. Probably not going to hit that by September expiration. But if it does go up, you might have to give up that stock. So you have those 100 shares, then you would have to release them. And so that's another potential downside if you really like being in the stock.
Look, there's no free lunch in options trading. And yes.
No free lunch anywhere.
Right. And so the downside is yes, when you sell out of the money calls, it's a high probability that they're going to expire worthless, or you're at least going to make money on those calls. But the downside is that you are capping your upside. So if UNH rips to $1,000 a share, well, unfortunately, you're only going to be able to sell your shares at, in this case, at 325. You bought them at 300. You're selling them at 325. It's still a win. It's a first-class problem, but you're not going to make the huge gain that you would have had if your position was uncapped.
All right, before we go, I want to ask you one takeaway for options traders or people who are just thinking about getting started. What do you need to keep in mind about some of the risks?
Well, options are very enticing in the fact that they offer you leverage, okay? You can, with a very small account, you can take very outsized positions, and that's great if you win. Unfortunately, options trading is hard, just like all trading is hard, and you can very quickly lose all of your money. If you buy a call, for example, you are risking 100% of the value of that call. So I would strongly discourage you from putting too much of your account in any one trade. I personally don't like to risk more than 1% of my capital on any one trade, preferably less, because the name of the game is survival in options trading and all trading. So don't do anything that puts you at risk of being out of the game.
Yeah, if Sean says 1% and he's a pro, I would keep that in mind there. Very great talking with you here. And tune in to Stocks in Translation, our podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts.
Cracker Barrel is in the spotlight after controversy around its logo. But despite the attention, the company is still struggling with declining sales. Before we get into the challenges, let's take a step back and look at the business. Cracker Barrel is a chain of restaurants and gift stores. The restaurant serves classic comfort foods, while the gift shop sells clothing and decor items. The company operates nearly 660 locations across 44 states, most of them along interstate highways and concentrated in the Southeast. Florida has the most, making up about 9% of the total. Joining me now is Jon Taffer, Chairman and CEO of Taffer Dynamics and executive producer and host of Paramount Network's Bar Rescue. Jon, you're an expert in the restaurant biz. You're even opening up 2 new spots, which we'll get into in just a minute. But first, let's start with Cracker Barrel here. What did you make of the logo fiasco, the back and forth we saw this week, and the decision to go back to the original logo?
It's actually quite a scenario, Ali. Think about this. The market research team, the interior design team, the graphics design team, and the executive team all get compensated to understand their customer and to do things that appeal to that customer. Every one of them blew it when you think about it. So a terrible mistake was made. So now they have to say, how do we benefit from this? Well, President Trump talked about the fact that all eyes are on them right now, and he's right. Right now America's looking at them. Rather than going back to the old logo, why not do a logo contest? Why not take this look, expand it another 4 weeks, create a logo contest, introduce a new menu item, say we're not going to change the interior, we're going to make it better. And the problem that Cracker Barrel has, if we look at overall performance, this fiasco aside, if you will, Ali, is it's a brand that has a generational issue. And years ago, I used to run a resort in the Catskill Mountains, and the Catskill Mountains was quite a resort area many years ago, but their audience died. They never moved to that next generation. So Cracker Barrel is an Americana concept. It's based upon authenticity and some roots. But how did they get a younger audience? Well, they don't want to displace what they have. That was the mistake they made a couple of weeks ago. Don't displace. Let's grow the business. Ali, we talk in the financial world about they're down 3%, they're down 2%, they're up 4%. How many bodies is that? So if I were running Cracker Barrel, I would do the mathematics and I'd say, I have to generate X amount of visitations more each month per restaurant. Take that visitation number, because 3% isn't necessarily an embraceable number. But if I knew I had to increase guest counts by 80 visitations per restaurant per month, that becomes a manageable number. And that's what Cracker Barrel needs to do. They need to introduce a menu item. They need to do a couple of marketing programs. You see, if they can just increase guest counts by 1% a month, in 12 months, they're up 12% in guest counts. That's a serious growth of business. So they need to focus on guest count growth and not do any more actions that alienate their existing base. Grow it, don't displace it.
And it really is seen as this value play, right? Average checks are just over $14. This cheaper offering to consumers, but we are in this more health conscious era. We have GLP-1s, surging. Consumers watching their calories very closely. Is value alone enough? And to your point of evolution, how do they do that in a way that's authentic to their brand?
Yeah, that's the challenge, Ali. And they have to be authentic to their brand, or they have nothing. But there's a way to take older brands and make them popular again. We've seen these things happen over the years with suddenly an older brand becomes hip again. So they have to come up with a marketing strategy that makes sense. And it's not necessarily changing a logo. A brand isn't a logo. A brand is what it does, not the way it appears. So if they want to draw a new audience, they have to do that within their four walls. And there's ways of doing that. There's food specials, there's music format changes. There's a lot of subtle things they can do to start moving that type of a direction. But when you look at spend at $14, Ali, it's very easy to say at that kind of a spend level, to get my revenues back, what do my guest counts need to be? And a lot of the illusion of the restaurant industry is they say, well, our revenues are up 3% this year. Yeah, but you raised prices by 5%. As I see that, your guest counts are down 2%. So how did you grow business? That's the challenge. The challenge is to grow bodies, not necessarily spend. And that's what they need to focus on.
And Cracker Barrel is almost part of the lifestyle in certain parts of the country, to your Americana point. So how much should they and can they lean on some of that regional loyalty?
I think they can. Florida's a great example. Florida has, 9% of their restaurants. But Florida is a slightly older demographic in many of those markets. So it makes sense that those are markets where they're comfortable in. But these markets evolve, they get younger, they get gentrified. So they have to come up with a menu that looks a little more youthful, not necessarily ripping the interior part, not necessarily ripping, but a couple of new menu items that target a younger audience, maybe a slight change in music, maybe a slight uniform change, maybe starting to change some of the pictures on the wall to more contemporary people, not necessarily change the look. But there's steps that can be taken. And if you think about it, Ali, if they can just grow 0.5% a month, a percent a month. That's a great accomplishment for them. So the goals can be reasonable to get there, and the steps need to be incremental. As you said, it needs to evolve, not abruptly change.
Well, let's talk about the new restaurants that you're opening. 2 new Taffer's Tavern locations in Atlanta and Orlando this fall. I mean, based on what you've seen work, what hasn't across the industry, how are you applying those lessons to these new openings and really to what consumers want and are craving right now?
You know, it's interesting, and to your point, with the medications today to lose weight, health, mind, consciousness, we're finding people are consuming less. A lot of people, for example, that would have had an entree now come in and just order an appetizer, and they're full. So I understand that. So the amount of food people eat is down. The amount of money they want to spend has been stretched to the point that it's really hard to create perceived value in restaurant environments today. So that's another issue. The only place where we can really win is environmentally today. When you go to a restaurant, you got to have a good time. You got to feel it in your gut. There needs to be something fun about it, something relevant about it. You need to feel you're in an important place, a relevant place. It needs to feed you in ways other than your stomach. And those environments are the ones that are being successful today. So Taffer's Tavern, we're opening our 3rd location in Atlanta. Our first is in Alpharetta. Our second was in Mercedes-Benz Stadium. And we've done just that. You know, our video system is curated, not guys sitting behind the desk. Our music is curated by demographic and psychographic. Our environment is paced and energized in a certain way that feeds to that environment. And it's worked for us. So our 3rd location in Atlanta, and we're opening our first in Florida on International Drive in Orlando about the same time, mid-September. So we're doing very, very well. But again, we focus on environment. We believe that we're not in a restaurant business. We believe we're in a reaction business. We don't believe we make food. We believe we create reactions. We achieve those reactions through food. To us, our product is not the food. To us, the product is the reaction. That means we got to present it at a higher level to get you to react to it. The flavor profile needs to get you to react to it. We don't play music, we play reactions. We don't play video, we play reactions. It's a very deep approach to operating a restaurant. And we know that when we create the best reactions, we win.
Yeah, all about the vibes here. Jon, thank you so much. Really appreciate it.
Good to see you, Alex.
You too. Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance ahead.